If you look at the Coinshares Twitter feed right now, you're going to see a picture of me. It's a black and white picture, and it was taken in 1985. I was 22 years old, I had a 26-inch waist, and who's laughing? and I had a spectacular mullet hairdo. Same guy. I was pictured in front of a whiteboard, and that whiteboard was at Shell Center, the headquarters of Shell International Trading Company. And on that whiteboard was the sole record of the Brent crude oil cargoes that Shell Oil was buying, selling, and transporting around the world. This was a single bearer asset, a physical asset, with maybe 3 dozen users, about $100 million in monthly trading volume. And over the next 28 years, as I moved my career from Shell through Salomon Brothers, JP Morgan, and on to run my own hedge fund, my own energy hedge fund, I saw the birth of a new asset class. That meant thousands of new participants. It meant new contracts on options, forwards, futures, basis swaps, ETPs and ETFs, and indices. And today, oil is, I would describe it as, a high-frequency trading game. My first exposure to crypto was in 2013, or as I would call it, year 4 Anno Satoshi. And crypto was this unknown digital bearer asset with maybe 50,000 users and wallets, and at the time around $10 per coin, with about 10 million coins in circulation. That amounted to about 100 million in market cap. So today, after a number of milestones along the way, we're at a different spot. But back then, I looked at Bitcoin, and my thoughts about Bitcoin were very much instructed by what I'd seen in commodities. And so I embarked upon an attempt to do what I'd done in the energy space at the early formative years to the crypto space. And accordingly, I thought I'd try and attempt, there's three basic things. Number one, try and explain the investment thesis of crypto to institutional investors. Number two, assemble a team of experts. And three, create investment product that was fit for institutional purposes. We launched Global Advisors Bitcoin Investment Fund, or GABI, as it's now known, in 2014, and it was pretty slow to boot up, I have to tell you. But by 2018, when that fund was retired, it had been one of the most successful hedge funds of all time. So today, here we look at crypto. Crypto is hundreds of thousands of active wallets, tens of billions of dollars of trading volume. It's an entirely different animal to what we saw before. I was stunned to see the other day that there are now 48 companies in the world that have 48 companies that have 100 employees or more in the crypto space. And thus, I think the digital asset space, crypto space, however you want to reference it, is actually becoming incredibly important, and it's becoming the fourth vector of technology. Mobile, internet, cloud, blockchain. If you think about the most important companies and most significant companies in the finance business, you go back to a long period of about 70 years between 1860 and 1930. And over that long period of time, all of the powerful financial services companies you see today are in existence. And today, 90 years after that, we see Goldman Sachs, JP Morgan, Morgan Stanley, and the likes, and they're dominating that arena. But there's something very interesting happening today, which is banks are becoming technology companies, and technology companies are becoming banks. The vision for this is a new financial services architecture, an architecture which is based on a network rather than the existing hub and spoke system we see today. That struggle is going to take place in the blockchain arena. And our company, Coinshares, with $750 million under management, 25,000 clients, a stable coin, an index, 2 funds, $2 billion of turnover, and 5 offices around the world, is in that fight. To talk about these kind of things, we can't avoid the thorny subject of regulation. Global financial services regulation is incredibly complex, and regulators are usually very measured and slow-moving, deliberate people. But crypto's caused something of a tsunami. In 2016, I wrote a thought piece called Escape Velocity. And Escape Velocity contemplated whether digital assets would exist in isolation or whether they would exist in some sort of symbiotic relationship with the traditional system. At that point, there'd already been a couple of skirmishes. Charlie Shrem, in 2012, founded BitInstant, first brokerage company in crypto. He was convicted of money laundering offenses in connection with Ross Ulbright and the Silk Road website, and he was jailed at the age of 22 years old. In 2015, Ripple was fined $700,000 by FinCEN for violations of the US Bank Secrecy Act and for failing to register. And I'm not sure at that stage Ripple really had any idea about what they'd done to attract that fine. So today, we're getting over the event that came after that. And while regulators, were active in those skirmishes, they weren't particularly prevalent in the space as a whole. But then came the advent of the initial coin offering, and the initial coin offering really blew the doors off. So under the exemption to the Securities Act called the Howey test, and the Howey test is 1930s precedent law, which is a determination, it's a process by which one determines whether a financial transaction is indeed a security. And after billions of dollars of issuance, thousands of tokens, the SEC brought the shutters down on that. And that was a black mark on the copybook of the crypto industry, and it was a setback. Today, regulators are catching up, but I thought I'd just spend a few moments talking about, and I don't think you can talk about financial services and crypto without considering this, where the regulators are today around the world. So starting in the United States, in the United States we have a pretty tough crowd, the SEC, the CFTC, the Office of the Controller of the Currency, and FinCEN. There's a pro-crypto mood in America, but it's crypto done right. And I'm sure a lot of you will have followed the news the last few days from Commissioner Hester Pierce, aka Crypto Mom, with some pretty proactive steps now about how crypto can be sandboxed to a certain extent in the United States. There's been other developments there. Quite an activity around security tokens, securitization of various different assets, largely real estate. And it's been a little bit surprising that hasn't been, to date, more popular. There are some great companies Securitize, Polymath, Templum, that are trying to pipe these security tokens through the existing framework and using alternative trading systems and so on. And that is a work in progress, but it is very much a collaborative effort, I think, now. And there's a tremendous industry lobby in America to support that. There are some holdouts. The kick debacle, I think, is probably unwise, and also some issues around the Telegram equity raise that they did. So that's the United States. Switzerland. A few representatives here, I believe. Switzerland, I think, is the most proactive crypto jurisdiction in the world right now. It differentiates itself because the government of Switzerland is 100% behind the crypto initiative, and they've mandated the banks to do the same. It's the most well-documented framework for digital assets, and in a seminal paper that the Swiss Federation wrote, you can find a very intricate mapping between all kinds of legal situations and then their respective representations on the Bitcoin on a blockchain. Asia. Asia has been a tremendous engine for crypto, and there's still a lot of stuff going on there with the Asian giants, China in particular, Huobi, Binance, and Bitmain. But a lot of that stuff goes on onshore, but out of the spotlight. Simultaneously, those entities and others, not just from China, but other Asian countries, are deploying very rapidly around the world. Europe. Europe is moving fast in the right direction. Last week, we saw President Macron propose an entirely new crypto framework with the AMF, the French regulator, and that I would describe as a really positive step. In Sweden, where we domicile some of our products, I'd say there's an extremely pragmatic and active engagement with the crypto industry. And then we can switch to the UK. The UK, I believe, is somewhat out of line with regulators from the rest of the world. And we've seen a series of consultations in the UK. They were comprehensive, but I believe they were severely flawed. We've seen the denial of a number of landmark products. The Oxford Institute concluded that the FCA's tech neutrality policy had been abandoned. And unlike any other regulator, the FCA seems to have a fundamental issue with the very value proposition around crypto. So that's the regulatory framework. So for the rest of this this little chat, what I'd like to do is just talk about, within those boundaries and under that regulatory umbrella as it exists, what a digital asset manager like Coinshares, but there are others, what those kind of digital asset management companies look like, and what indeed they are doing in terms of going to market. And I think my first observation about that is, I was around after my early mullet days in Shell. I was around at the very early days of Salomon Brothers with John Goodfriend and John Merriweather and all the characters and cast of characters that actually were then immortalized in the book Liar's Poker. And Salomon Brothers at those days was a private company, as was Goldman Sachs. It was incredibly fast-growing, incredibly entrepreneurial, and those private investment banks that grew into what they are today were out there seeking new products, new marketplaces, new liquidity, and new trading techniques. And I think that's very much the starting point and the analog in terms of maturity where we are with digital asset managers today. So the structure of a digital asset management company really follows 4 pillars. Something we've called FIC, fixed income, commodities, and currencies. Then investor product, then services, and then what I describe as ancillary activity. So for us and for others, it looks like this. In FIC, we'll do trading. We'll provide liquidity for products. We'll do arbitrage. We're now entering a new phase in non-linearity and options. And we do a lot of asset and liability management, so lots of borrowing, lots of lending. And that's the FIC bucket. In the investor product bucket, we're seeing a lot more variety now these days. So we're seeing funds, and those funds typically will be the venture, early stage crypto infrastructure. We're seeing trading funds, and we're seeing sort of discretionary trading funds, and we're seeing quant funds. There's a product segment which we'll call ETPs, ETFs, exchange-traded products, exchange-traded funds. We'll talk about that a little bit more in a second. There's the issuance of security tokens. There's the issuance of asset-backed tokens. There's the issuance of stable coins. And there is an emerging business in indices. So let's call that the product suite, investor product suite. We then have a services segment. A services segment I would describe as custody, research, and advice. And then surrounding these activities in the digital asset management framework is the ancillary services that we all rely on. So things like payment networks, forensics, blockchain forensics. What else we do? Data, platforms, and these all sort of feed into and support that digital asset manager structure. So I want to just talk about sort of 4 of these things today, so that you can understand what the challenges are, what the opportunities are, what we do, and maybe a few tips for people that are thinking about sort of getting into this kind of arena. And I want to start with custody and indices. Now, you might think that's an unusual grouping, but I'm grouping that together on purpose, and I'm grouping that because that was very instructive in the evolution of the commodity space. So I describe the 28-year life cycle of maturity in commodities as having 2 distinct phases. The first phase was very much industry specific. So oil companies, merchants, traders, refiners, the odd investment bank. And the market grew tremendously with that cohort of people. The next thing that happened was the marketplace, the asset class, if you like, became interesting to institutional investors. And it became interesting to that group of people because of the emergence of China as a massive commodity consumer. But that wasn't enough. It wasn't really until the Goldman Sachs Commodity Index, a clear, well-documented, replicable, intelligent product was created and marketed and distributed. It took many years, actually, for that to really get traction. But that was absolutely a prerequisite for the institutional adoption of commodities. But there's something sort of unique about crypto which needs to be added into that mix, and that's the concept of custody. Because unlike in the commodity space, in crypto, obviously, we face security risks, and you simply just can't tell an institutional investment management committee that their assets have been hacked. So we're seeing the emergence of custodians in the crypto space. And again, they really fall into 2 categories. One, what I describe as the fiduciary kinds. Now, I'd put Fidelity and Coinbase and Kingdom Trust into that bucket. And then you have a new kind of breed of custodians that doesn't really have a parallel in the institutional sort of commodity space, which I describe more like guardians, software solutions, digital security. Our sponsors BitGo, Copper, Anchorage, and other such companies like that. Personally, I'm not convinced that the technology solution is going to be enough for institutional adoption. I think that what will happen is that the big names, because in the legacy space, the big names are Bank of Mellon, New York, JP Morgan, Goldman Sachs, there's huge names. They differentiate themselves because you can sue them. And I think that what's going to happen is that the way forward for the institutional custody space is that some of the bigger existing names may roll up some of the more interesting technology companies. Other even better capitalized companies may come in. And that combination of a strong fiduciary and some cool technology will be the institutional custody solution. And I think we'll get there within the next 12 months. And that combined with some interesting index product that's out there or coming out there, I think that's going to be a very compelling case for the institutional investor. So that's custody and indices. Next thing we can talk about, ETPs, exchange-traded products, subject very dear to my heart and at the core of what Coinshares does. Now, ETPs, if you don't know, are just a wrapper. They're a wrapper around crypto that enables normal investors to access crypto from their usual brokerage or banking relationships. And it's very important for the crypto space because it's a gateway and a funnel by which investment that's needed to boost network values, to spur innovation. It's the gateway by which that capital actually gets into the crypto industry, or one of them at least. So that's why it's important there. For investors, I think it's also got some tremendous benefits. And before I get onto that, let's just think about what is it actually that an ETP gives you in terms of protections. There are different models around the world, but we'll take Europe as a typical example. At the top end, you're going to have a prospectus issued under the EU directive by a local regulator. And that prospectus is going to contain information about the issuer, the audited accounts of the issuer, the governance, the directors, a whole bunch of risk warnings, and a description of the structure of the product, the fees associated with it, and so on. And that prospectus will be approved by a local regulator. You then go to a second phase. The second phase is admission to trading. So when you are admitted to trading on a major marketplace, there will be a whole bunch of, in our case, warrants and certificates listing rules. And those listing rules will cover things like, do you have the appropriate technical IT infrastructure? Do you have disaster recovery? Are you managing your news flow and announcements under the market abuse regime correctly? And so on and so forth. And also, obviously, another key factor there, surveillance of what's going on with that instrument. But you're still not even at the market yet. To get to the market, there's a third step. And that third step is that product that needs to be distributed via an XO, an execution-only platform, like a Hargreaves Lansdown or an Interactive Brokers or an AJ Bell. And those people give a third layer of protection. And that third layer of protection goes around AML, KYC, client appropriateness, research, alerts, and most importantly, kids. So you have kids, not these kind of kids. Key investor information documents. And the key investor information documents then put in plain English everything that's gone before, from the prospectus to the marketplace and down to the broker that's distributing. So there's a tremendous amount of stuff that is very beneficial for investors. And investors like it. They like it because they may be buying Bitcoin or crypto as a hedge for a much bigger portfolio, which makes it kind of a little bit too much hassle to then go and open a different account somewhere else. People are confused by the proliferation of crypto venues and similarly may be put off. And there are many, many reasons why investors find this very interesting. The regulators, generally, we're very fortunate to have got our product into the marketplace very early. It's harder to do it now, and it's harder to do it now because regulators have taken pause. And they've taken pause for a number of reasons when it comes to issuing exchange-traded products linked to crypto. Those reasons are, number one, there's a lot of nervousness about the asset class. It's a very volatile asset class, and because future returns are not determined by historical performance, there is some skepticism about whether that volatility is worth enduring. There is a nervousness about the issuers, because a lot of the issuers that come to the ETP space do not have the kind of regulatory track record and the kind of experience that has been usually seen when we've seen more conventional exchange-traded products come to the marketplace. So there is some resistance on the regulatory side to these kind of issuances, but I think the regulators are soon going to get more comfortable with price discovery, market surveillance, custody, the quality of the issuers, and the strong desire that investors actually have to buy these products. As far as practitioners in the space are concerned, I think it's very important that we continue to push and get investors and get regulators comfortable with this and explain the benefits and explain the alternatives, which is often case going to a highly unregulated, highly risky, perhaps leveraged, even more risky venue somewhere else. So that's the exchange-traded product space. Next big driver at the moment, stablecoins. Stablecoins are kind of a hot topic right now. I'll talk about CBDCs, central bank digital currencies, in a second, but let's focus on basic stablecoins at the moment, which really fall into two categories. Stablecoins backed by some sort of fiat money, and stablecoins backed by hard assets, usually gold. So these are, stablecoins. And there's kind of a prescription for this stuff. There's a prescription that has been developed by us. We have a gold-backed coin called DGLD. We've learned a lot about the do's and don'ts in that space, and it really comes down to doing three things correctly. First of all, if you're issuing a stablecoin, if you're thinking of buying or trading a stablecoin, point number one, let's think about the regulatory framework in which it exists. For us, a prerequisite to creating a stablecoin was we needed absolutely bulletproof regulatory certainty about what we were doing, not just in current period, but for the future. And when you do that, you have to think about certain things. You have to think about where is the locus and the substance of my actual business, like where are my people? Then you think about where is the domicile of the product itself. And then you think about into which marketplaces am I selling this product. And if you're interacting or issuing or thinking about a stable coin, ask yourself that question first. Because if that question isn't answered correctly, there probably isn't a lot of longevity in that particular project. Second thing, make the technology work with the regulation. One of the most important things we feel about stablecoins is if you're looking at the underlying asset, don't hypothecate it, don't pool it, don't put it in an SPV. Give me direct ownership through my digital token of that asset. And maintain that connection between the digital token and the asset at all times. When that breaks, you're inviting a whole bunch of other issues. You might be stumbling into collective investment fund scheme legislation, MiFID legislation, banking regulation. So the key is, keep that connection very tight. And it's not an easy technology solve to do that. I think the second thing to think about with technology is, what kind of a network are you going to put on and rail your stablecoin on? So there were really two types. One type of network I describe as unconstrained. So ERC20 as an example. An unconstrained network is a great way to get to market because it has instant distribution. The problem is, if you look at what's happening now and the comments that FinCEN have made and issues on the upcoming implementation of a travel rule, which is information about financial transactions that moves and travels with a transaction, it is far from clear to me that an ERC20 network can support that kind of information flow. So I'm a little skeptical about whether there is a future for ERC20 railed stablecoins. On the other hand, if you go for a more private network like an R3 or a Quorum or something like that, you end up with a lot of the controls that you need. You know, you can produce some sort of self-sovereign chain of custody, then that's all great, but how do you distribute it? And I think solving that dilemma between the unconstrained network and the sort of common sense about what you might need to tell a regulator about what's going on in your network, I think that dilemma needs to be solved by anybody that's engaging in this space. And then finally, you know, what are you doing with this stable coin? What's the go-to-market strategy for a stable coin? And for us, certainly with gold, our tagline would be the world's most durable asset on the world's most secure blockchain. We use a sidechain to the Bitcoin blockchain. That's the big picture. And who's going to be attracted by that? Well, a really robust gold-backed token is an out-of-the-box currency for a country that has a weak currency, Argentina. Secondly, I think it's a great vehicle to transfer bulk value in stable form across the crypto sphere. Now, we all know that there is Tether, and we all know what the issues with Tether are. There are other dollar stable coins that are issued by trust companies and banks in America. And my assertion would be, if I'm moving a lot of value around the crypto system, I'm not sure I want it to be either through a US bank or necessarily you know, with an entity that doesn't rise to, you know, the highest reputable standard it could rise to. So that's the second go-to-market strand. And the third one, I would say, is exchange-traded funds. And there's a huge market in exchange-traded products, I should say products, not funds, exchange-traded products for commodities and for assets, in gold and platinum and palladium and, you know, you name it. There is an ETF that will support that. And where we're finding a lot of interest is when we tokenize gold, you're removing a tremendous amount of friction. And I don't really mean friction in a financial sense. I mean friction in a sort of chain of intermediary sense. And if you're buying gold as a hedge against financial calamity, and in order to execute that, you're buying a call option on a GLD or a PHAU, then, you know, you've got an option market, an option pricing agent, an option broker, probably one bank or transfer agent, and then you've got the underlying ETF, which has got an SPV and a security trustee and another bank and another broker and another exchange. Well, I would say if financial calamity ever does happen, then I don't think you're getting your gold. So to cut all of those links out and to make a digital stablecoin, a digital token, ownership of an underlying asset, I think is a very powerful tool for the ETF investor. So that's stablecoins. We did indices and custody, we did stablecoins, we did ETPs, and the final one I'm going to talk about is central bank digital currencies, another kind of hot topic. And I was absolutely stunned the other day to flip on the TV late at night and to catch the last 20 minutes of Christine Lagarde's maiden speech at the European Central Bank, because she spent the last 20 minutes talking about a central bank digital currency. And she's not alone. We've now seen some pretty interesting moves, not just from there, but in China, in Switzerland, and even, believe it or not, in the UK. So you know, what is the motivation behind doing this? And I think this is a very, very interesting thought experiment. Well, first of all, we haven't had a situation before where central bank money gets directly into the monetary system. We've got this layer of commercial banks, lots of SIFIs, lots of too bigs to fail, and they're all sort of scattered around the landscape. But a central bank digital currency, arguably, could go straight to the source and straight to the consumer. That's one stunning sort of development. And there are some other really obvious reasons why a government would want to do a central bank digital currency. One is you can pretty much eradicate the black market. Secondly, you can save all the money that it costs you to print physical cash. You're going to have a much better AML trail, and you're going to have an incredibly powerful surveillance tool. So there are some pretty strong reasons and great advantages why a government would want to do that. But there's one more that is much more important, and it's an older thesis than you might think. Before I get onto that, just one final point on the concept of how these central bank digital currencies might look. It's interesting that you might think if we do go down this digital route, you might see a situation where the old pairing of fiat money and gold is actually replaced by a new pairing of CBDCs and Bitcoin or some other crypto. But let me get back to the first, what I was just going to say. The other really interesting advantage that a central bank digital currency gives you is this. In 2015, a chap by the name of Mervyn Goodfriend, who's a fellow at the Carnegie Mellon University in America, a former Federal Reserve board member, wrote a paper called Unencumbering Interest Rates at the Zero Bound. And he mentioned all of these things concerning the advantages of a central bank digital currency to a government. And he added one more, and that's this. In the last 8 US recessions, the Federal Reserve lowered spot interest rates between 250 and 350 basis points. And they lower spot interest rates below the 10-year yield so that they can incentivize people in periods of economic stress to advance spending from the future to the present. Classic monetary stimulation. And so that's those 8 events that happened in the past. But if you look at where we are today in this sort of spooky, somewhat deflationary environment, if you have another monetary crisis and it is necessary, in whichever area of the world it may be, to drop interest rates 300 basis points lower than where the prevailing 10-year rate is, given where 10-year rates are, 17 out of 20 of the G20 countries would have meaningfully negative interest rates. And without a central bank digital currency, there is no way you can prevent wholesale flight into physical cash that would result in consumers being told that the pound they have today is going to be worth 95p at the end of the year. And I think that if we remain in this low interest rate general environment, and if we do see any kind of financial stress, there'll be much, much louder calls for all the reasons above, but particularly to enforce digital haircuts on money for governments to do that. So those are 4 of the many areas that we see the digital asset manager active in: custodies and indices, stable coins, ETPs, and as a partner, technology partner, liquidity partner in CBDCs. Those are the 4 things. So I'm going to wind things up just now by recounting a great moment in my Bitcoin journey, which was at the 2015 Bitcoin Foundation conference in Amsterdam. And I'd been doing Bitcoin for about 2 years before I went, and I never actually met anybody in real life. And I went there, and I wasn't sure whether it was going to be sort of 6 guys in a Starbucks. But there were 2,000 people, and I was struck by the vision, the passion, the intelligence that this group of technology people had. I'd been to a lot of oil conferences by that time, and this was like a breath of fresh air to me. And at that conference, I met a chap called Dan Moorhead. And Dan, as I'm sure a lot of you know, is the founder of the San Francisco organization, Pantera. And at that conference in 2015, Dan and I, in a room of 2,000 people, were the only 2 financial people there with that kind of background. The other people that were at the conference were people like Brian Armstrong, who founded Coinbase. And Brian had a table covered in balloons and flyers telling you about his new exchange. George Kikvadze was there, and Bitfury were just deploying their first mining hardware. Bitfinex were there. I think they had 3 employees. And at that point, no one had ever heard of CZ. And so what's happened, since then is just mind-blowing to me. A lot of the OGs from that conference have now gone on to form some of the biggest and most valuable companies in the crypto space. And so the message to those guys, some of them are here, is let's keep pushing. And let's keep working together. But you might be new to the space. You might be new if you've never been hacked. You might be new if you don't know what the word hodl means. You might be new if you think a Merkle tree is some kind of a German shrub. And if you think there's any chance whatsoever that Craig Wright is Satoshi Nakamoto, then you're brand new. So if you're new or brand new, then my message is this. Be passionate. Be passionate about crypto because you love it. Be passionate about crypto because you want to disrupt. Be passionate about crypto because you want to get rich. Be passionate about crypto because you change the world. And I would say, bring the passion no matter how you do it. Because if you don't do it in this crowd, you won't succeed. But today, you're going to hear from a lot of other people. Bring that passion, learn from them. There's a great pathway and a great future in this industry, and I'm sure a lot of people will meet a great success as a result. So thank you very much for allowing me, BlockWorks guys, thank you very much for allowing me to make this keynote address. It's been a great pleasure. You guys have good luck, have a good day, and hodl on.